Yeah, today capital's kind of chasing going down two different paths. In some respects, they're chasing the big GPs, and we're seeing a lot of capital concentrated in with a small group of GPs. And we're also seeing capital flow to a number of niche or smaller managers. And being in between is a little bit harder today than it was. I would say the general good news is that the overall market is improving. That is, there's more capital coming after real estate private equity today than there was over the previous 2 or 3 years. We're almost back to '05 levels. In '04, there was about 45 billion of capital that flowed into real estate private equity. In '05, about 75 billion. This year, we'll see somewhere closer to the 70 billion in flows to real estate private equity, and I think that's good news for managers. It's not necessarily bad news, though, for investments because at the peak, about 135 billion flowed in. So we're nowhere near the peak. We're at a fraction of the peak, yet capital is increasing into our market. 3 years ago, people were still in shock mode and very nervous about what was happening in the overall market. And a number of investors were worried, for example, that Europe was not going to come back. And so 3 years ago, when we were talking about European strategies, investors had no interest. Over the last 12 to 24 months, I think people have realized that Europe is not going to disappear, and therefore they're starting to look at Europe as really one of the opportunities, best opportunities on the globe for accessing distressed real estate. And so we're seeing a lot of capital raised for distress in Europe, and to some extent stress in the States. There have been lots of changes in terms of where capital is coming from over the last 3 or 4 years, more than I've seen really in the last 20 years of doing this. And what the big difference is, I think, is that there's a lot more capital coming from the Asia and Australia region. Most of the capital historically that we've raised has been from the U.S. It's still the majority of the capital that we raise. But this year, for example, at Greenhill, 15 to 20% of the capital that we raise will come out of Asia, Australia. That's never happened before. And where it's going has changed also. 5 years ago, capital was very interested in the BRICS and the emerging markets, and that was all the rage. We were raising India funds, we were raising Russia funds, if you can believe that. We were raising China funds. Today, as people look around the world and say, okay, where are the opportunities? If they think they can generate a 20 in the States or a 20 in Europe, major developed markets, their choice today is probably to go back to those markets to get that 20 and not go to China to get those kind of returns. I think the interesting opportunity, though, is, for example, we're working on a China-focused fund right now, is that there's a lot less capital chase in China now. So therefore, some interesting opportunities are emerging in China. So sometimes when you go where capital ain't, it can pay off. Yeah, I would say what has people motivated about the funds that we're working on are first and foremost the people running the fund, and have they done this before, and have they done it well, and do they have passion for what they do? Then I think the second element is this a strategy that makes sense in the context of the current market? So I think that could be value add in the States. I think that could be distress in Europe, and I think it could be growth in places like China and some of the Asian markets. And then lastly, I think investors want to see a proven track record. It's a lot harder to get a first-time fundraise for that reason, but people want to see that people have done this before. And so if you have those three elements, I think your fund will get done, given the amount of capital that's coming into the market today.